We are witnessing the biggest drop in home buyer demand in US history right now, with mortgage applications to buy a house plummeting by 63% from their pandemic peak. This collapse in buyer demand suggests that the spring housing market this year is going to see a lot of empty open houses and a lot of price cuts. In fact, we're already seeing these price cuts take hold right now as the median list price for houses across America is down year over year in about 50% of states. However, even with these initial declines in prices we're seeing in certain states, the overall price levels for houses are still in the biggest bubble of all time. So I want you folks to take a look at what this very alarming graph is showing. The annual income needed by Americans to buy a house, and what do you see is the massive spike in income required to buy a house over the last 5 to 10 years. Americans now need to earn $110,000 just to even qualify for most mortgages. That's a cost level that we have simply never seen before in US history, and we've actually never seen this lack of affordability sustained. But the first thing I want to touch upon before that is how the Fed got this situation so wrong. Because we were told heading into the end of 2024, entering 2025, that the Fed was going to cut interest rates and mortgage rates were going to get cheaper and that housing was going to get more affordable due to these rate cuts. But that hasn't happened. Something very interesting has happened, everyone, since the Fed started cutting interest rates, which was right around mid-September. That's when the Fed started cutting interest rates, right around September 16th. You can see mortgage rates at this point bottomed around 6.1% in mid-September, and then very quickly after that, mortgage rates shot back up and are now all the way to a level of 7.26%. That's where the 30-year fixed mortgage rate is right now, according to Mortgage News Daily. So we're actually at one of the highest mortgage rates that we've seen in the last 2 years since the rates started going up, even with the Fed cutting interest rates. And this is what's particularly scary, because it's almost as if the Fed has lost control of the economy and of interest rates in the economy. This shouldn't happen where the Fed just is seemingly impotent in terms of their ability to drive demand and drive interest rates. And instead, the bond market is taking over. The bond market and buyers and sellers of 10 and 30-year US Treasuries are taking over, and they're saying, hey, we think actually, Fed, you might actually have to increase interest rates in the future. And that's frustrating for home buyers out there, because it doesn't seem like there's going to be mortgage rate relief in the near term, and that's causing the buyer demand to just completely fall off the table. Through the first week of January, the Mortgage Bankers Association reported a mortgage app index of 128. So this is an index benchmarked to show how many people are applying for mortgages to purchase a home. That index through the first week of January was down 14% from the same week in 2024, 20% from the same week in 2023, 54% lower than the same week in 2022, 60% lower than the same week in 2021, and 52% lower than the same week in 2020. So we literally have 52% fewer buyers applying for mortgages now than we did right before the pandemic. And this, of course, is now starting to have consequences in the housing market for sellers. In particular, one of the biggest consequences we're seeing is that the days on market for houses is going up by a lot. When a seller lists a house, often, they're still listing at a price that's unrealistic, and it's just sitting on the market for days and days, and no one is buying. And this is especially true in a market like Florida. For instance, you can see in Florida that the days on the market is now 79 days. This DOM is the highest that we have seen in the last decade. Just for perspective, in 2021, during the peak boom, that DOM went down to 55 days. That's part of the reason how you knew there was a tight market and that prices would go up. Well, now we're at 79. So with this DOM so high in Florida, as well as some other parts of America, that's now going to mean more downward pressure on prices. And that's now causing price growth to slow in many markets, and it's even causing price growth to go negative year over year. And where I think prices are going to go negative are the areas in blue, particularly dark blue on this map. These are areas with the lowest Reventure App price forecast score. I'm going to get into this in a little more detail in this video too, explaining to you guys what this price forecast means and how accurate it is at predicting the future of price growth in your market. But first, let's talk about some projections for mortgage rates in 2025. Where are mortgage rates going to go to by the end of the year? And this is a tough question, everyone. And I kind of say this to myself, like predicting mortgage rates the last 3 years has been a fool's errand in the housing market. There's been numerous times I thought rates would start to go down, and then the Fed reversed course or inflation expectations reared their head again, and rates ended up going up. But I think at this point, it feels like a pretty solid bet that by the end of 2025, mortgage rates are still probably going to be above 6.5% unless we see some type of big economic downturn. If we see some type of big economic downturn, that could push rates lower and bond yields lower. But absent that, rates are probably going to stay in the range of 6.5 to 7.5%. So maybe we'll see rates drop a bit from their current level of 7.2 into the high sixes as the year goes on. But I wouldn't bet as a home buyer that you're going to see significantly lower mortgage rates than you are right now. And this is something I think a lot of you guys intuitively understand, because I actually polled you about a month ago here on my channel, and I asked the question, do you think it's a good or bad time to buy a house heading into 2025? Now, 14% of you said good time to buy, 66% of you said bad time to buy, 20% of you said not sure. So really, a vast majority of you think it's either a bad time to buy or you're not totally sure. And that negative sentiment on the housing market is also echoed in the Fannie Mae housing survey. Each month, Fannie Mae issues a survey on the US housing market asking Americans what they think about the housing market. In the most recent month, 78% of Americans said they thought it was a bad time to buy, where 22% thought it was a good time to buy. So pretty similar results to how I polled you guys on my channel. Fannie Mae is finding something similar. And you can see historically, it's actually quite the opposite. Normally, Americans think it's a good time to buy a house. Like if you go back to 2010, even during the last crash in 2010, 72% of Americans thought it was a good time to buy. More broadly speaking, Americans are pretty optimistic about buying into the housing market. However, not anymore. They're very pessimistic. And the reason they're pessimistic is because prices are too high. It's the price levels that are the main reason why so many buyers are on the sideline. It's not mortgage rates. Mortgage rates are an issue, but really a 7% mortgage rate is not historically unprecedented. A 7% mortgage rate is actually historically normal. Rather, what's unprecedented is how expensive prices are today in the housing market. And you can get a sense of just how historically expensive houses are today by looking at this graph, which measures inflation adjusted home prices over the last 134 years in America. And what inflation adjustments do, everyone, is it takes the home value growth and adjusts it downward for the level of inflation. And we put these home prices here in 2022 dollars. So basically, this is telling you over the last 134 years, how much a house would have cost at 2022 inflation and price levels. What you can see is that the long-term average going back to 1890 is $169,000 for a house priced in 2022 dollars. And what you can see is that from 1890 all the way to 1997, 1998, home prices didn't grow. Adjusted for inflation, they stayed the same. But then, starting in the early 2000s, we had this big spike in housing bubble 1, then we had a crash, and now we had another big spike in housing bubble 2, where prices adjusted for inflation are at their highest level ever. They're more than almost 80% above the long-term inflation adjusted norm. And what's important to understand is that when we look at mortgage rates, which is now the orange line, we can see that today's mortgage rate levels nearing 7%, those mortgage rates are basically at a normal level. They're a bit above where they were from 1890 to 1964, and they're below where they were during the great inflation of the 70s and 80s, kind of back to where they were in the early 2000s. And I think when you look at this graph, a high 6% mortgage rate makes some intuitive sense as being a normal mortgage rate. But what doesn't make sense is home prices this expensive. And so that's where the relief is going to have to come on the housing market if we are going to see relief. It's going to have to come on home prices because income and wages, they'll probably grow at 4%, maybe 5% in 2025. There'll be some improvement of affordability on income and wages, but it's not going to be nearly enough for most buyers. So if we are going to see an improvement in affordability in 2025, it's going to have to come through lower prices. And it's going to have to come in certain states first because there's certain areas of America where prices are now dropping and will probably continue to drop in 2025. If we go back to this Reventure App home price forecast score by state, let's talk about my forecast for the different states and where I think prices are heading. And let's lead off with Florida, everyone, because Florida actually has the lowest price forecast of any state, a 38 out of 100. And when you see this forecast below 50, that means downward projection on prices. You could see a year ago in Florida, we were at a 48. We were kind of at a neutral market. We were starting to predict the slowdown. Well, now we're saying into 2025 at Reventure App that Florida is really going to slow due to the supply and demand fundamentals really shifting in favor of buyers. Texas also has a pretty low price forecast, 39 out of 100. You could see in Texas that this is now 2 years in a row where the market has incrementally shifted more to a buyer's market. In Texas, the big issue is inventory. You can see we now have 108,000 homes on the market in Texas at the end of 2024. By far the highest level for the month of December, going back at least 7 years. You can also see that we're starting to see weakness in the mountain states, Colorado in particular. This is a sneaky market, a sneaky downturn market where we're forecasting prices are going to drop. You could see we went from a seller's market, a score of 70 in Colorado, down to a 46 the last 2 years, which is kind of neutral to slightly declining. Well, now we're forecasting real declines heading into 2025 in Colorado. And I'll get into some more of these states in a second. However, I want to issue a caveat and a warning here and just urge some caution using this price forecast. So while you can use it at the state level and the metro level, and it's interesting to see how prices are forecast to go in your state, in your city, you really have to dig down to the neighborhood level in your zip code to get a more accurate reading on the direction of your market. Because the one thing I'm seeing is that there's often big differences within a state, within a city, in terms of how home prices are heading and projecting. For instance, if we zoom in on New York and look at Manhattan, you can see the prices in Manhattan are forecast to be down or maybe stable with a slight negative tilt over the next year. While if you go over the river into New Jersey, the prices are forecast to go up by quite a bit. Meanwhile, prices in Long Island are forecast to go up. And these are all in the same metro, everyone. So if you were to look at the metro forecast for New York, you wouldn't really get the accurate neighborhood level. You would have to go to look at the zip codes. We're also seeing this big time in Los Angeles. So in Los Angeles, and we'll see actually how these fires and the unfortunate things going on there are going to change this, but already in LA, we were having downward forecasts in the center of Los Angeles County as well as to the northwest of Los Angeles County, while we were having upward forecasts in Orange County. So look at this, almost like a dividing line here between upward forecast, growing prices, downward forecast, decreasing prices in LA. Seeing much the same in Miami. In Miami, to the north of the downtown, we have downward pressure on prices, but if we go to the southwest and some of these nicer suburbs, we still have stable to positive forecast on prices. Now, one thing I'm really excited to reveal is that the Reventure App price forecast score performed very well at predicting prices in 2024. We actually just ran the numbers on this here at Reventure App, and we found that among large metro areas, our Reventure App price forecast score predicted where prices were heading at a 0.74 correlation coefficient, a 74% correlation coefficient, which is very strong. You can see that represented on this graph where we're tracking what the Reventure App score was in 2023 for all the different large metros in America versus what the home price growth actually was in 2024. You could see a really strong positive correlation. So our score was very good in 2024 predicting prices. And the reason it's good is because we actually look at the fundamentals driving prices in each market. We look at the inventory, we look at the price cut rate, we look at the days on market and the recent appreciation trends. And if you understand those metrics for your city and zip code, you have a pretty good read on what's going on with prices and where they could head in the future. And so what I would suggest you guys do is head to www.reventure.app and look at the price forecast score for your state, metro area, county, and zip code. Now, we have two pricing plans here at Reventure App, everyone, for that premium data on the forecast score. The first option is the monthly pass, which is $39 a month. It unlocks those scores as well as 40 other premium data points to help you as a buyer gain understanding about your local housing market and where prices could be heading. However, what a lot of people are doing recently is signing up for the annual pass, which comes at a 15% discount. So it knocks down the monthly rate to $33 a month. That allows you to track the data month in and month out over the next year as you prepare yourself for your home buying or investment purchase decision. So sign up for that annual pass so you can see what the Reventure price forecast score is for your area and understand its components. If the score is below a 50 with a downward arrow, that suggests we think prices are going to go down in the next year. If it's above a 50 with an upward arrow in red, that means we think prices are stable or going to go up.